Jake Claver is saying, we're there. Not soon, not someday. We're there. It could be Friday, it could be Monday, but according to him, price could explode as the carry trade finally unwinds and Japan pulls the pin by raising rates. And if you understand what that actually means beneath the surface, then you understand why this moment matters far more than most people realize. Because this isn't about a single rate hike. This is about decades of cheap money, leverage stacked on leverage, and a global system that only works as long as liquidity stays easy. When that changes, everything reprices at once. That's exactly why I built the Millionaire Formula, 100x your wealth, a system focused on uncovering hidden, undervalued stocks before the crowd and positioning early for true 100x wealth potential. It's linked in the video description. Now let's get back to what's actually happening because this is where things start to get serious. Jake's comment about Japan isn't hype, it's math. For decades, the Japanese yen has been the backbone of the global carry trade. Investors borrow yen at near zero rates and deploy that capital into risk assets, equities, bonds, real estate, and yes, crypto. It's essentially free leverage. As long as Japan keeps rates near zero, the trade works. But the moment rates rise meaningfully, that entire structure starts to unwind. Jake made a very specific distinction that most people gloss over. A 25 basis point hike, that's a trickle. Painful for some, manageable for most. But 50 or 75 basis points, that's when things turn violent. That's when forced liquidation kicks in. That's when leveraged positions have to be closed. Not because investors want to, but because they have no choice. And historically, those moments don't play out slowly. They happen fast, often over weekends, often when liquidity is thin. That's why the phrase, Happy Monday, matters. Markets love to move when participants are trapped. If Japan delivers a larger than expected hike, the unwind doesn't politely wait for everyone to reposition. It cascades. Assets that were propped up by cheap yen funding suddenly have to find real buyers. And when that happens, correlations go to 1. Now here's where most people get confused, especially in crypto. They assume that a liquidity shock automatically means crypto down. And initially, they're often right. Risk assets get sold first. But that's only phase 1. Phase 2 is where things get interesting because once the dust settles, the system looks around for assets that can actually move value efficiently, globally, instantly, without counterparty risk. And that's where XRP enters the conversation. XRP doesn't need Japan to hike rates to have a use case. That's not the point. The point is that moments of systemic stress expose inefficiencies. They expose trapped capital. They expose how slow, expensive, and fragmented the legacy financial system really is. And when trillions of dollars are suddenly under pressure, institutions don't ask ideological questions. They ask practical ones. How fast can I move money? How cheaply? How safely? How much yield am I losing by keeping capital idle? This is where the Nostro and Vistro system becomes impossible to defend. Banks park trillions of dollars around the world just to facilitate payments. That money earns nothing. It just sits there trapped waiting. Now imagine a world where that same capital can earn even 1% yield 24/7 and still be available instantly when needed. 1% on trillions is not a rounding error. 2 or 3% changes balance sheets. That's not speculation. That's basic arithmetic. Ripple has been quietly assembling the pieces to make this possible. XRP as the bridge asset, a regulated stablecoin. Ripple Prime, Hidden Road, banking licenses, institutional liquidity relationships. This isn't a retail narrative. This isn't about meme coins or hype cycles. This is infrastructure. And infrastructure only becomes visible when the old system starts to crack. That's why I actually agree with one subtle point you made. Japan hiking rates and XRP's long-term value aren't directly connected, but indirectly they're absolutely connected because stress accelerates adoption. Crises don't create innovation. They reveal which innovations were already ready. And this is where regulation finally flips from headwind to tailwind. For years, institutions couldn't touch crypto without risking lawsuits. The SEC was hostile. Rulem was non-existent. Everything lived in gray zones. That era is ending. The Genius Act has laid the foundation for stable coins. The Clarity Act is coming. Harmonization between the SEC and CFTC is underway. The regulatory perimeter is being drawn. And once it is, capital moves fast. You're already seeing the early signs. Tokenization is no longer a fringe idea. BlackRock KK didn't enter this space for fun. They entered because tokenization solves real problems at massive scale. Settlement times collapse from days to seconds. Counterparty risk drops. Capital efficiency skyrockets. That's why tokenized treasuries and stable coins are leading the charge. You start with the most liquid assets because that's where the money is. And once equities, bonds, and treasuries live on blockchain rails, liquidity fragmentation becomes unacceptable. You can't have half the system on legacy rails and half on tokenized rails forever. Eventually, one wins. And history tells us that more efficient systems always replace less efficient ones. Not overnight, but inevitably. This is also why the ETF conversation matters more than people think. Wisdom Tree, CoinShares, 21 Shares, these aren't meme companies. These are serious asset managers responding to institutional demand. ETFs are demand funnels. And they don't care about ideology, they care about flows. And when flows hit a constrained asset, price adjusts, especially when OTC desks start drying up. Because here's the uncomfortable truth. There is not infinite XRP available at market prices. Circulating supply matters. Liquidity matters. And if large players need size, they have limited options. Ripple's escrow isn't a vending machine. Exchanges aren't bottomless. At some point, price has to do the work. Now layer all of this together. A potential carry trade unwind, a fragile global liquidity environment, regulatory clarity arriving, tokenization accelerating, ETFs lining up, institutional infrastructure already built. This isn't one catalyst, it's convergence. And convergence is what creates nonlinear outcomes. That's why waking up on Monday to nothing happening feels frustrating. Not because something is guaranteed to happen on a specific date, but because the pressure has been building for years. Systems don't break when everyone expects them to. They break when complacency peaks. And whether it's this week or this quarter, the direction is becoming clearer. Value is moving on chain. Settlement is going instant. Yield is becoming programmable. Liquidity is becoming global and continuous. And assets that enable that movement don't need hype. They need relevance. This is the shift most people will only recognize in hindsight. When legacy rails feel obviously obsolete, when tokenized assets feel normal, when moving millions across borders in seconds feels boring, that's when people will say it was obvious, but it never feels obvious while you're inside the transition. And that's where we are right now. Not at the end, not at the beginning, but right in the middle of the inflection point where macro pressure, regulation, and technology finally align. And once you see it that way, you realize this isn't about picking a date on the calendar or hoping for a green candle on Monday morning. It's about understanding where capital is being forced to go when the old pathways no longer work the way they used to. Liquidity doesn't disappear forever. It relocates. And the biggest reallocations in history always happen quietly at first, before price makes it obvious. That's why tokenization keeps coming up in these conversations, and not just from crypto native voices. When you hear CEOs from firms like BlackRock, CA Apollo, JP Morgan, and BNY Mellon all saying variations of the same thing, it's worth listening. They're not talking about tokenization because it's trendy. They're talking about it because it fixes plumbing problems that cost them billions every year. Think about settlement alone. Today's system requires layers of intermediaries, reconciliation across siloed ledgers, and days of waiting where capital is frozen. During that time, risk exists everywhere. Counterparty risk, settlement risk, liquidity risk. Now compare that to atomic settlement on a blockchain, where delivery versus payment happens simultaneously instantly with cryptographic finality. That's not an incremental improvement. That's a generational leap. And when you reduce settlement time, you don't just make things faster, you free capital. Capital that was previously locked up as a buffer can now be deployed elsewhere. That increases velocity, it increases yield, it increases efficiency across the entire system. That's why tokenized treasuries exploded first. Not because treasuries are exciting, but because they're safe, massive, and already widely held. Putting them on chain was the lowest friction way to prove the model. Stable coins are the same story. The largest tokenized asset in the world isn't a stock or a bond, it's the dollar. Tokenized dollars move 24/7 globally without banking hours. Once institutions get comfortable with that, everything else follows. Bonds, funds, equities, derivatives, and eventually, yes, more complex assets like real estate and private equity. But here's the key point that often gets missed. Private blockchains don't solve this alone. You can tokenize assets on private ledgers all day long, but without access to deep, neutral, global liquidity, you hit a ceiling. That's where public blockchains come in. They act as the connective tissue between walled gardens. They are the liquidity layer. This is why interoperability matters more than maximalism. The future isn't one chain to rule them all. It's multiple systems, private and public, interconnected, and the assets that thrive are the ones that can bridge those worlds efficiently, compliantly, and at scale. That's the context in which XRP keeps reappearing, not as a meme, not as a cult asset, but as a utility designed for exactly this environment. Instant settlement, deep liquidity, neutral bridge, regulatory engagement instead of avoidance. You don't have to believe every bullish projection to see that the design aligns with where the system is going. And when regulation finally stops being an existential threat and starts becoming a framework for growth, adoption accelerates. Institutions don't move on vibes. They move when lawyers say yes. The Genius Act, the Coming Clarity Act, SEC and CFTC harmonization, no action letters. These aren't headlines for retail traders, but they are green lights for trillions of dollars. That's also why ETFs matter beyond short-term price action. An ETF isn't just a product, it's a distribution channel. It allows pension funds, advisors, and institutions to gain exposure without touching wallets, keys, or exchanges. When demand comes through that channel, it's persistent, it's structural, and it doesn't panic sell the way retail does. Wisdom Tree managing over $100 billion isn't noise. CoinShares refiling isn't noise. These are signals. And the moment larger players like BlackRock, KK, or Fidelity decide client demand justifies it, the game changes again. Not because they bless an asset, but because they unlock access at massive scale. At the same time, supply dynamics don't magically adjust. XRP isn't inflationary in the way fiat is. There's a fixed maximum. Circulating supply is what it is. Liquidity can be deep, but it's not infinite. And when daily absorption starts consistently exceeding new supply coming to market, price becomes the balancing mechanism. This is not financial advice. That's why OTC desks running dry matters. That's why escrow decisions matter. That's why regulatory outcomes around distribution matter. These are not retail concerns, but they directly affect price discovery. Zooming back out, the macro backdrop makes all of this more urgent. Global debt is enormous. Liquidity cycles are tightening. Carry trades that worked for decades are under pressure. When cheap money disappears, inefficiency becomes intolerable. Systems that waste capital get replaced by systems that don't. And historically, those transitions don't reward the crowd chasing headlines. They reward the people who positioned early, understood the infrastructure layer, and had the patience to wait through boredom and skepticism. This is also why comparing everything to Bitcoin misses the point. Bitcoin is digital gold, a store of value, a hedge. That's a valid role. But infrastructure assets play a different game. They're about throughput, settlement, and connectivity. Ether, Solana, Chainlink, XRP, these are not competing with Bitcoin. They're building the rails underneath the new financial system. And no, none of this happens overnight. Legacy rails won't vanish tomorrow. There will be a transition period where both systems coexist. But liquidity hates fragmentation. Over time, it consolidates around the most efficient path. By the end of this decade, it's very likely that blockchain rails are the default, not the alternative. When that happens, people won't talk about crypto adoption anymore. They'll just talk about finance. And the assets enabling that transition will be valued very differently than they are today. That's why moments like this feel tense, because we're standing between narratives. The old system still mostly works until it doesn't. The new system is already working, but not everyone is using it yet. That overlap is where volatility lives. It's uncomfortable, it's noisy, and it's where opportunity hides. Whether Japan's rate decision is the spark or just another crack doesn't really change the trajectory. The direction is set. Capital wants speed, yield, certainty, and the ability to move instantly in a 247 global market. If you can see that, then you're already ahead of most people. And if you can act on it intelligently with a framework instead of emotions, that's where real wealth gets built. Not by chasing candles, but by understanding systems. That's exactly why I built the Millionaire 100x formula, to show you how to find hidden undervalued stocks before the crowd and position early for true 100x wealth opportunities. This is about spotting the next breakout before the system reprices.